Good morning from London. I'm Anna Edwards alongside Guy Johnson and Tom Mackenzie. We're an hour away from the opening trade. Here's what you need to know. The French president offers a nuclear shield for Europe as leaders gather for an emergency security summit in Brussels. The bond sell-off goes global. Japanese benchmark yields soar to their highest in more than a decade after German 10-year Bunds tumble the most since 1990. Stocks gain as Donald Trump gives car makers a one-month exemption from tariffs. Plus, the European Central Bank will most likely cut rates today, but the path ahead leaves economists really divided. We're live in Frankfurt for ECB Decision Day.
And European futures pointing to another strong session after the gains of around 0.9% yesterday, currently pointing higher by close to a full percentage point. The outperformance with the US continues apace. Bund futures pointing to another sell-off after the jump in yields yesterday. As you said, the biggest move since the 1990s. The benchmark 10-year also being impacted. The sell-off across treasuries as well. 431 right now, yields up 3 basis points. And the strength for the single currency, 108 on euro dollar, currently up 0.1% with hedge funds now building out the positions around the euro. The countdown to the opening trade starts right now.
In response to the historic appeal of the future German Chancellor, I have decided to open the strategic debate on the protection afforded by our deterrent to our allies on the European continent. Whatever happens, the decision has always been and will remain in the hands of the President of the Republic, head of the armed forces.
The French President Emmanuel Macron speaking to the French people last night, offering up the French nuclear deterrent as a possible common shield that Europe can exist under going forward from here. Where does that leave the UK? I think that's a critical question as well. Today, though, Anna, a war council in Europe.
Yeah, absolutely. And so this address from Emmanuel Macron comes the day after. And as you see Europe taking its defence challenges more seriously, it's interesting to think of the relative strengths that the various European economies and countries bring to this. France may be more stretched on the budget side, but it has a nuclear deterrent. Germany doesn't have one of those, but it has room on the budget side. And so interesting to see these pooled interests coming through here. We are moving on to the European stage then, 150 billion in loans we heard from Ursula von der Leyen at the beginning of the week, plus 650 billion in other measures. Can they all get round the table? Can they fend off any resistance from Viktor Orban and others?
And Friedrich Merz has clearly laid down the gauntlet for other European leaders. And to what extent does Italy, does Spain and others around the table, the northern partners as well, align with this spending impulse coming from a previously recalcitrant Germany?
Yep, good word. So we've got this council meeting today, European Council meeting. Leaders are going to come together. Can we classify this as a war council? It feels like Europe is trying to figure out what the alternative to NATO could be. Now, this is a big step, and I'm not saying that Europe is going to step away from NATO, but it's looking for a plan B in case that reality exists. If you're talking about the French nuclear shield, potentially the UK nuclear shield being used as an alternative, that is a big step forward for Europe. And Europe standing on its own 2 feet defensively, potentially offensively, is a huge step, and it changes the relationship again with Washington in a very big way. Yeah,
an emergency defence summit, if not a war council. But yes, certainly the stakes are really high. And we've seen the relationship between the US and Ukraine, and by extension, perhaps, some of the other Western allies being stretched of late, with the cutting off of aid to Ukraine and the cutting off of military intelligence to Ukraine. That puts the US, Western allies, in a very difficult situation, and that conversation ongoing about how much they are able to share with Ukraine.
And to what extent does Hungary's Viktor Orban play a spoiler when it comes to pushing through some of this defensive? There is a mechanism for them, apparently, to be able to get some spending through without a full consensus across 27 nation states. But Viktor Orban, clearly, with that proximity to Moscow, could play the spoiler card.
So Europe needs, if it's going to do this, it needs to figure out this isn't a defence union we're talking about here. If you think about the architecture of European defence, NATO obviously is the primary function, provides the primary function there. But if you're thinking about European security architecture, does that now need to exist outside of the EU in terms of where it is housed, based? It could still be in Brussels, who knows? But if you're going to include the UK, Norway, various other parts of the European continent within that, and provide a mechanism for circumventing Hungary.
We should probably, just for balance, remember Mark Rutte's comments recently saying NATO still exists, Article 5 still exists,
of course
the US has signed up to it.
Of course it still exists, but it's being threatened. in a way that it hasn't been threatened for decades.
Of course. And that's why they're meeting in Brussels.
And that's why they're meeting in Brussels. This council meeting is a potential first step to with kind of figuring out a new security architecture.
Wherever we land on that NATO debate, Friedrich Merz clearly underscoring his commitment, and he said this after the election, is that it seems like we have to weigh up the possibility that the US walks away from NATO. So that is part of his calculation, Friedrich Merz, and that is what's led, one of the catalysts, one of the for the huge decision that Germany's
And so bond
making.
markets responded to this yesterday and increasingly around the globe. Is it all priced into France? Because Emmanuel Macron last night was saying he doesn't want to put taxes up to pay for whatever it is he's going to do on the defence side. So we'll have to watch that.
But is the price that Europe is willing to pay higher yields? And how significant will that price be? Clearly, yields are likely to rise as a result of this. Germany, and we've already seen an indication of that from the markets, how much further they do rise from here. Is that something the ECB needs to think about as well? I think that's going to be an interesting question for it today. How it is looking to manage curves going forward, I think, will be a serious question if Europe is going to spend this kind of money. But if you think about Dan Curtis, wrong Dan, was running the numbers on this. European equities are up significantly more than European bonds are down this year. Is this a price that Europe is willing to pay?
And what you're pointing to is a potential fracture further down the line across the Eurozone when the pain comes through across those budgets, whether it's welfare or labour support in Spain, in Italy. They're singing from the same hymn sheet now, it seems, with the yields higher on that gravitational pull of Germany. To what extent does that lead to fractures down the line when they have to confront very tough spending proposition?
Is it a zero-sum game? Does Europe need to take away in one bucket and put that money into work in another bucket?
On a sort of more positive narrative, I suppose, Marcus Ashworth out with a note this morning from Bloomberg Opinion talking about this being the right kind of bond route. And boy, have we seen we have seen some wrong kinds of bond routes over recent years. So nice to see this coming from a good place. It doesn't reflect any nervousness about the periphery, and therefore a retreat into Bunds is something completely different.
It's a supply-driven story. As much as everything else.
All of it,
To what extent does the spend around defence offset the tariffs that are coming through remains a question. And
what's the multiplier? What's the multiplier effect when you spend on military, especially if in the short term a lot of that military spend has to go to the US? And that's very pertinent as we go to the ECB.
Is Europe next, I think, is a key question when it comes to the tariff conversation. And to your point, is Europe breaking to a certain extent some of the gravitational links it's had with the US markets of late? But the tariff story, again, gets even more confusing. Now we have a 1 month carve out for the car sector.
Is this by design, or is this a Trump administration that is flip-flopping under the inevitable pressure of the auto industry and agriculture? And if they are, how did they not foresee this? To what extent is this a consequence of a president being surrounded by yes men and yes women versus Trump 0.1?
Right, it's quite nuts, the market reaction to this, isn't it? We got very excited at the thought of what this was going to be, this supposed going a little easier on Mexico and Canada. And then we even went higher. Car stocks went quite a lot higher on 1 month of relaxation of these tariffs on these particular borders. Quite amazing. And now we're talking about whether agriculture gets a similar carve-out, but again, only till April the 2nd when the full tariff picture may become clearer.
The Canadians are basically saying you've got to take them all off, otherwise we're not taking any of them off. So it's there's so much unknown here. So what that creates for the market is a sense of uncertainty. The flip-flopping creates uncertainty, and that is bad for risk-taking. Both at the corporate level, do companies invest? At a market Wall Street level, do investors invest in companies? I think this is the question that is now being asked, and does that ultimately, potentially further down the road, create some recessionary indicators that start to flow into the US data set?
Because whatever happens in terms of how these tariffs evolve, the damage is being done right now, even if they are walked back in their entirety.
Yeah, I mean, Howard Lutnick pushing back on that narrative yesterday, wasn't he? Saying he doesn't see... He quoted lots of companies that are investing in the US, the ones that make the headlines, and suggested that that's, you know, that's confidence, that's corporate confidence. But if they are looking for, in just 1 month, American companies to prove they're investing more in the United States, you know, that's quite a big ask.
Services were strong yesterday. We're going to get payrolls tomorrow. Key data sets coming through that we're going to have to pay a great deal of attention to. Let's talk about what we've got coming up on the show today. We've got 4 C-suite guests coming up. Peter Dilnot, the Melrose CEO, here to talk about aerospace, here to talk about defence. Richard Oldfield, Schroders CEO. Numbers just dropping onto the screen. Big day for the aviation sector. We've had numbers out from Lufthansa. We are going to be speaking as well to Ben Smith, the Air France-KLM CEO, talking about a significant push higher in terms of the EBIT line that he is going to be producing this year. more than 300 million euros. Helene von Roeder, Merck KgaA's CFO, is going to be joining us as well. And we've got Bishan Shu from Royal London Asset Management to talk markets. Really looking forward to this conversation as well. Moritz Kramer, Landesbank Baden-Württemberg's chief economist, formerly something of an expert on ratings, joining us as well to talk us through what he sees in Europe.
OK, for your diary, 11:30 a.m. UK time, we're going to get that EU Special Summit on Defence, of course. Oliver Crook is on the ground. We are leading up to that key summit, and any additional lines we get from lawmakers, of course, and leaders on the ground in Brussels. 1:15 p.m. UK time, we're going to get that ECB rate decision, of course, followed by that press conference from Christine Lagarde half an hour later. And at 1:30 p.m. UK time, we will get US jobless claims ahead, as Guy was saying, of non-farm payrolls on Friday. And this evening, Scott Bessent speaking again, this time to the Economic Club of New York. And later, Fed speak, including from Atlanta Fed President Raphael Bostic and Fed Governor Christopher Waller. To the ECB then, likely to cut rates for the 6th time since June, later this afternoon. Let's cross over to Frankfurt. Bloomberg's Lizzie Burden is on the ground. Lizzie, lay out what to expect then.
Well, Tom, this has got to be the most exciting ECB meeting in quite some time because of what you've just been talking about. Bunds yesterday having their worst day since the fall of the Berlin Wall because of this whatever it takes policy. And more importantly for our purposes than that, or traders kind of binning their euro-dollar parity predictions, is that you've seen traders paring their bets on ECB cuts for this year. So 67 basis points is where we're at so far. It was 90 basis points of cuts for this year at the start of the week. And then if you compare that to the tariff threat, look, you've got Donald Trump talking about 25% tariffs on autos and all other things, but it's just a threat at the moment. And ostensibly, the ECB doesn't make policy when it comes to threats. And so we don't even know how the European Union is going to retaliate to that. But it creates a lot of uncertainty on how they'll balance the two. Does it slow the cadence of cuts as they wait to see what Trump's tariff policy is going to be? Even before this slew of news, they were divided on the Governing Council. You had some who were worried about sticky services inflation and higher energy costs, others who were worried about sluggish growth. And so anything really could happen from April. Some analysts say that April is going to be the last cut. Others say that you're going to have cuts all the way to 1% by the start of 2026. The thing that markets really need to watch out for today is, do they drop the description of policy as restrictive? Because if they do, to many that would signal that there's going to be a pause or an end to rate cuts. And if they don't, many would read that as a sign that there's going to be another cut in April.
OK, so watching for how they define the level of rates and whether restrictive is phased out in the language. Of course, Bloomberg's Lizzie Burden on the ground for us in Frankfurt ahead of that ECB meeting, with divisions ultimately being exacerbated by the spend coming through from Europe. There's full coverage, of course, of that ECB decision from 1:15 London time here on Bloomberg, with ECB President Christine Lagarde's news conference at 1:45.
Looking forward to that a little bit later on. Let's tell you what else you need to know this Thursday morning. Bloomberg has learned that Washington's Commerce Department is tapping Morgan Stanley banker Michael Grimes to lead a planned US sovereign wealth fund. Sources say Grimes is leaving the bank after 30 years to head up the new wealth fund, which is part of President Trump's effort to give America a stake in projects that he considers critical to national security. Alibaba shares have surged again in Hong Kong after the company released an AI model it says can rival DeepSeek. China's e-commerce leader claims the new open-source model performs as well as DeepSeek with just a fraction of the data required. Baba is seeing a growing prowess in AI, and mounting signs of China's support have boosted the stock by around 70% this year. And Bloomberg understands that Klarna is set to file publicly for its US IPO as soon as next week. The Stockholm-based payments business aims to price the offer as early as April and is targeting a valuation of more than $15 billion. Klarna is working on the listing with around 15 banks, led by Goldman Sachs, JP Morgan and Morgan Stanley. I can kind of understand why Klarna wants to go to the market now. We're potentially about to see a turn in the credit cycle. We're potentially seeing a turn in the consumer. Is this the moment to crystallise some of the gains?
Yeah, that's interesting. You go to the timing. I went to the geography.
Well,
as in, is it a disappointment for Europe that it's going to the US? But we've known that for some time.
Clearly it is.
Are we over that?
The US market is, I believe, now their largest market for Klarna. They're going to be laser focused on that for the last 12 months at least. The valuation's kind of been all over the shop, of course, of this company during the pandemic.
It's been massively
40 billion or something.
We're now talking 15.
Exactly. So they've taken a bit of dive down on terms of the valuation, but they're building out. They've been leading on implementing AI. The CEO, Sebastian Siemiatkowski, talks about this a lot in terms of the efficiency gains they're getting there. That to what extent is that puff?
Can you value these buy now pay later businesses until they've been through a full credit cycle?
So his call as well is that they are far more than just that. They're trying to become a real contender to incumbent banks. They're offering far more financial services than just buy now, pay later, is what they are suggesting. In fact, the units...
They will become... That's where they want to go.
They've started to put the legwork in there. They have started to build a foundation on that.
Sure.
His ambition is to really challenge the
Maybe they want to benefit from the regulatory environment, as it might be with President Trump in the White House. Let's see. We have plenty of corporate earnings to talk about this morning as well. Coming up, Lufthansa upgrades its profit outlook for the year. But is it enough to boost the share price? We'll get to the aviation sector. Meanwhile, Air France-KLM, also from that sector, posting a solid fourth-quarter beat. We'll dig deeper into the European airline story with the Air France-KLM CEO later in the programme. Plus, European indices look set to extend yesterday's gains amid the global bond sell-off. Stay with us for today's Open. Up next, France calls for nuclear talks while European defence ministers meet. We will get a view from the CEO of the aerospace engineer Melrose. That's coming up next. If you have questions, if you want to get involved in any of these conversations, the news coming thick and fast this Thursday, 6th of March, please get in touch. IB plus BBTV Go is the function on the Bloomberg terminal. This is Bloomberg. Welcome back. This is the opening trade. Now, the British aerospace manufacturer Melrose Industries has reported adjusted operating profit for 2024 that beat estimates, as well as confirming its 2025 guidance. So far, so good. For more, let's speak now to the CEO of Melrose, Peter Dilnot, who joins us on set this morning. Peter, very nice to have you with us this morning. So you're confirming your guidance, and I just wonder how much certainty you can have around the guidance when you look out to 2025. So much volatility, a fear of tariffs, of course, around the United States. How much visibility do you have?
Well, good morning. And the first thing to say is we have delivered a strong performance in 2024, actually, despite actually all the most recent changes, some pretty volatile times around our supply chain, and operating profit came in ahead of expectations, as you say, despite all that. And I think that shows the resilience of our business. Our guidance is confirmed because we have got a very long order book, and we serve both civil and defence customers. And that order book needs to be filled. Yes. And the key challenge, actually, for an industry at large is to meet that demand. OK,
I mean, some of those civil and aerospace customers are in the United States, aren't they? And I wonder what a tariff conversation looks like when you put together the business to talk about this. What conclusions do you come to?
Well, again, let's just step back for a moment, because at the end of the day, we've got a business here which is both on the civil and the defence side. We've got very, very long demand. Actually, we've got order books are long. In some cases, it's going to take 10 years to fulfil on the civil side. And on the defence side, as you say, you've got a rising tide of increased spending. So our position, we've spent a lot of time at Melrose repositioning the business to be able to have design-led positions on those platforms, embedded onto the platforms. And as that rising tide comes up, if you like, with both demand and the supply chain, easing, we are going to see that read through in terms of our results, and that's why we're able to step forward.
So a rising tide, but what about that tariff question?
Yeah, so tariff specifically. The first, we are a global business, and we have an operating footprint that is both in Europe and in the US and also in Asia. So most of our supply actually is within region. So that's an important point. We've obviously looked at the tariffs. And assess those, and it's not material for us within Melrose. Most of the flows actually would be impacted between Mexico and the US, wouldn't be material. We're obviously staying alive to it, but the other thing I would say about aerospace, it's a global business, it's clearly volatile, and also there are contracts in place, which means that this needs to be worked out who's going to bear the pain. So tariffs are not material for us as it stands at the moment, again, reflecting the fact that we are a global business with a global operating footprint.
Peter, good morning. You're a third defence.
Yes.
Europe now wants to spend a lot more on defence, clearly. Is that where you see... How does the growth sort of within the defence side, within the one-third, change as a result of what you're hearing?
Yes, I mean, you're right. We're about two-thirds civil.
Yep.
And one-third defence. The civil side of the business is set for strong growth,
Yep.
has been for some time, and that's both because of the, again, the increasing in production rates as we meet that demand, and also because we have an aftermarket business, and the civil world has been quite busy, so we have a lucrative aftermarket, which is growing fast, but also is generating significant profit for us. Defence is clearly set for more growth than we expected. There's a question mark, obviously, as we all know, around exactly what the US is going to do on spend going forwards. But we also have a European footprint here serving that defence market. And the other point I would say is quite a lot of European defence spending is actually on US platforms. And so...
Do you think that changes?
I think it may change, but defence and defence procurement is a long cycle business.
Yep.
So I think if there's going to be a rapid step up in defence spending, operational fleets, for example, the UK, Germany, Italy have F-35 fighter jets. So if there's going to be an increase in spending, there may well be a read across to American platforms, while Europe also steps up independently. And as Melrose, we're positioned well to deliver for both of those things.
If you talk to Guillaume Faury, he's trying to ramp his 320 programme.
Yes.
He has struggled to do so because of supply chain issues. If Europe starts doing more in defence, does that make the supply chain issues that exist in totality of aerospace, kind of think about it as sort of wider, become even more problematic?
I think there will be more tensions. The aerospace, I mean, step back again, is aerospace's biggest challenge is to meet the demand. The demand is there, and we as an industry have been working hard to address those supply chain challenges. Actually, to be honest, they affect us mostly indirectly, as you say, Airbus having challenges to ramp up. So there is work to be doing through the supply chain. Some of the supply chains overlap, but some of them are quite discrete. But I think you're right in saying that there is going to be more demand for European aerospace, global aerospace capability, and it's about industrial capacity and skills. But that's what we as an industry need to step up and do.
So, Peter, on that tightening supply chain question, does that lead to higher pricing?
In terms of...
Well, you have to offset. You're going to see higher prices across the supply chain because of the constraints. And so you either absorb that or you pass that on to your customers.
Well, I think overall that's clearly how economics work, and why, for example, that the aftermarket has been particularly strong, because there has been a shortage of supply, and therefore demand's there and prices increase, partly to offset the incremental cost of investment, but also to get reasonable returns. So I think the way we look at defence, actually, and we've got a stated strategy to get reasonable returns from our defence programmes, but the drivers actually on our economics, which is what Melrose here, we're talking about a very significant step up in profitability. It's not driven purely by price, it is driven by volume, our business improvements, and mix.
Does defence become a bigger part of the market, and what more can you lean into that? Are you looking at acquisitions in the defence space?
So defence is, I mean, we just talked about it.
A big part of your unit.
I mean, clearly as defence increases, then naturally it depends on how much it increases versus civil, which is also set to increase. But naturally, if the spend increases, it's going to be a bigger part of that.
You need to make acquisitions?
No. We have set out targets today, which are around 20%, over 20% compound annual growth rate in EPS out for the next 5 years, which don't include acquisitions. So our primary focus is organic growth.
Thank you.
We've got a great equity story.
Melrose CEO Peter Dillon, thank you. Plenty more coming up. Stay with us. This is Bloomberg.
Welcome back. 30 minutes until the start of equities opening trading here in Europe, cash trading. Let's have a look at the futures picture, though, and that already tells us what we need to know about whether yesterday is done for markets. No, it seems it continues, the positivity at least of yesterday. So growth expectations on the rise for Europe as a result of more spending in Germany on infrastructure, more defence spending across Europe. We'll see what the multiplier is of all of that into the European growth story. Of course, we have the ECB today, but for the moment, we expect to go higher. CAC futures, incidentally, take the best of the gains this morning, up by 1.3%. There is some corporate earnings news around this morning too. Let's have a quick look at bond markets, and we see a continuation of yesterday there as well. We see France, actually, interestingly, because we've heard from Emmanuel Macron about the need to spend more on defence there, but they're not going to put up taxes, so how are they going to pay for it? Well, we do see bond market yields going higher, up 9 basis points on the French 10-year. We're up 8 basis points in Germany, so it is a broader European story. Across Europe, we're up by between 4 and 9 basis points, it would seem, at the 10-year horizon. Tom.
OK, you talked about the earnings story. Let's get to one of those earnings pictures being built out right now. Schroders reporting 2024 assets under management at £778 billion, close to £779 billion. The UK's largest standalone asset manager is setting ambitious new 3-year targets in order to revive growth in the business and sees £150 million annualised net cost savings over 3 years. Joining us for an exclusive conversation is Schroders CEO Richard Oldfield. Richard, good morning. Is there more that you can do to squeeze costs out of this business going forward? Is that target ambitious enough?
Well, good morning and thanks for having me. So the first thing I'd say is I've been in this seat now for 4 months and I am always astonished every day. I've spoken to 120 clients in that 4 months and they've all told me what an amazing business I lead. So as I think about the future, the ambitious plan that we've outlined is to get us back to earnings growth. And that's what our shareholders want. We have to grow both our assets under management, as we did last year, and our profitability. We think we've been super ambitious in that you're right. We have outlined 150 million of cost savings, a route through to revenue growth for each of our businesses. So if I take our public markets business, we're looking to stabilise the revenue trend that we've seen in recent years, and that should go back to growing market share. In our private clients business, we're looking to grow our assets under management, increase the rate of net new business to 20 billion over the next 3 years. And our wealth business has always done fantastically well, actually. We've always had a leading market target for net new business growth of 5 to 7%, and we're recommitting to that today. So overall, what we're looking to do is to reduce our cost-to-income ratio from the 75% that we had in 2024 down to below 70% by the end of 2027. So we think that's quite a lot.
OK, and we want to get your views on the wealth management business and how you lean into that. But before I get there, Richard, would you consider, in terms of that cost alignment, have you discussed maybe getting rid of some of the underperforming parts of the business, whether that's in the public or private, and offloading some of those businesses? Is that part of the calculation going forward?
So one of the things I'd really like to bring out is the synergies that we've got from our business overall. So importantly, when I look at our asset management wealth businesses, they really do support each other, is the first thing I'd say. So whether that's actually our wealth business providing insight to our asset manager to innovate, or actually it's our asset manager creating product for our wealth business, we actually have natural synergy in the group. And the reason why that's important is as I look at the client segments, the lens that we look on our client base, the wealth segment is forecast to grow fastest at 7%. And we have a fabulous franchise across Asia, and in particular, that wealth segment is going to grow at about 10%. So standing back, actually, I think our group has this real benefit from having asset management and wealth alongside each other. What we are, of course, doing is all aspects of our business to make sure that they're performing.
OK, good. So a clear focus on the wealth business as you set out, and on some of those synergies and getting back to growing profitability. Can I ask you about the private markets side of Schroders and whether you have plans to lean more quickly into that area?
So I'm delighted this year, actually, that we had one of our best fundraising years, actually. We raised over £10 billion worth of assets in Schroders Capital. And what we need to be really clear about is we're not in Schroders Capital trying to do everything across all types of private markets. We're actually really, really good at certain things within each of the categories. So, for example, within private equity, we're a world leader in small and mid-sized private equity. And actually, when I stand back and look at that business, we have no issues with realizations, for example, because the small companies we invest in are really interesting targets for large organizations or other PE houses. So the target that we have outlined of generating 20 billion of net new business over the next 3 years is already a step up from the rate that we've achieved over the last 3 years. And we'll continue to lean into that business because of our clients.
OK, and Tom was asking about whether certain parts of the business might be up for sale. What about, I mean, I note this morning you're talking about £150 million annualised net cost savings over 3 years. What's the story about how you're going to get there? Are there going to be jobs involved, and is technology playing an increasing part of the business?
So, Anna, there's a really detailed plan that supports that 150 million, as you'd expect, and it broadly covers 2 areas. And I should say, by the way, we've already taken 20 million out of the cost base through savings in the first quarter of this year. But of the remaining amount, it comes from 2 sources. Simplifying our business. We've invested hugely in our operating infrastructure, and we really need to get the benefits of that investment that we made over recent years. So a large part of the saving is just simplifying our business. In addition to that, we want to leverage our suppliers and our strategic partners to also create cost savings for us, and we think that's another important part. So it's a multifaceted plan. It covers a number of areas,
yep.
And that's how we're getting the 150 out over the 3 years.
Richard, sorry, good morning, it's Guy. Can I just come back to the simplification element of that? And dig a little bit more deeply. What does that look like? Is that consolidating funds? Is that closing offices? Can you provide a little bit more on what simplification actually in reality looks like?
Sure. Let me give you a couple of examples, guys. So one of the things we're doing is looking at how we do research in the organisation and simplifying our research platforms. We spend a lot of money on research, as you can imagine. Another really good example is absolutely you're right, thinking about our product range and strategies. We've already closed more than 10% of our funds this year, and we'll be looking at doing much, much more as we go forward. The important lens, by the way, is not just cost on that, it's actually making sure we have a fund range that is what our clients really need. And we're looking at where we put our capital for growth and where we focus our capital, so that means we're being really quite thoughtful and careful about where we actually save money so that we can invest in the business for growth.
Yep. Physical footprint, what does that look like going forward? Is it smaller?
Well, you know, it's interesting. People often don't realise that we operate today in 45 different markets at Schroders. 38 of them we have a physical location in. And it's one of our great strengths, that geographic diversification. We have a brand, by the way, it's quite astonishing. Not only is it a top 5 brand globally, it is in a top 5 position in many, many of those 38 different markets that we're physically in. Now, do we need all of those 35 markets going forward? Well, that's absolutely the thing that you'd be expecting us to ask ourselves, but we want to make sure that we're serving clients in the way that we do today.
Been great to catch up. Richard, always a pleasure. Thanks very much for spending some time with us this morning here at Bloomberg. The Schroders CEO, Richard Oldfield. Coming up, we're going to continue the conversation around what European corporate reporting looks like. Air France-KLM saying this morning that it's aiming to lift seat capacity by between 4 and 5% this year. It's boosting its operating profit target as well by €300 million. We've heard something similar this morning from Carsten Spohr over at Lufthansa, but Ben Smith is being a little bit more specific. We're going to speak to him next. He is the CEO of Air France-KLM, and he's coming up next. This is Bloomberg.
Tariff arrangements between Canada, Mexico and possibly even Europe going forward. We're in uncharted territory, Guy. The demand for our services in the next 6 months or a year are very strong, irrespective of this. But which way this goes, it's uncharted, so we'll just have to wait and see. My own view is that this will resolve itself. There will be, over the next 6 months, a year, a reset. I think the level of tariff will possibly fall.
Emirates Airline President Tim Clark speaking to me yesterday. So, Tim, a little bit more cautious than maybe he has been of late in terms of the demand outlook. Certainly significant uncertainty on his radar screen. We've got a host of European airlines reporting numbers this morning. Lufthansa out with its figures. The stock is actually called lower, which is interesting, seeing 2025 adjusted EBIT, quote, significantly higher year on year. Now, Ben Smith over at Air France has been a little bit more specific on what he sees in terms of 2025. Air France-KLM this morning seeing at least a €300 million EBIT improvement in 2025. Its EBITDA line this morning has beaten. Ben Smith is the CEO of Air France-KLM and joins us now. Ben, good morning. Always a pleasure. How do you get to that 300 million EBIT improvement in 2025?
Morning, Guy. We had something very specific this year in our main market in France. We had the Paris Olympics, and we had a one-time hit of about 250 million euros. And we've seen a big rebound back to normal trading levels in the fourth quarter. So we're quite sure that that was a one-time hit, so that we see rebounding. And in addition to that, we had a new cargo system that was installed in the first part of the year, which cost us a lot of money, and that's now done. So we don't see that recurring next year. So that gives us a confidence that the 300 million that we took as a hit this year should not be there next year.
So once I back that out, you see demand actually remaining fairly strong. Is that the picture? Is that what you're planning for this year as well?
Well, Q4 for the group, Air France-KLM, was a record quarter for us. So we're quite pleased. And what we see at the beginning of this year is strong. And for the rest of the year, as of today, we don't see any additional headwinds. So we're quite confident for 2025. And we're pleasantly surprised with the final results of Q4 2024.
Ben, good morning. Tom here, alongside Guy and Anna. Guy, obviously speaking to Tim Clark, and the question put to him, of course, around tariffs. To what extent, how much are you factoring in a potential tariff impact on the business going forward this year?
Look, I think it's a bit too early. We have a few buffers that are there. For normal changes in the marketplace. But as of today, we don't see any impact, but we are following it very closely. But as of today, we don't see any impact at all on bookings.
Do you see any change in terms of appetite to travel to the United States?
Well, we hear from some other markets that have been hit with heavy tariffs that there are some significant reductions in traffic flows to the United States. We are actually seeing, maybe there could be a compensation. We continue to see big increases in demand from the United States into our main market of France. So if there is some kind of a hit, on outbound travel from Europe, I think we can compensate it from a stronger point of sale United States into our main markets. France is still a very, very exciting destination for many, especially Americans, and we're seeing that in particular in the premium leisure markets. We're investing heavily in premium leisure. We've got a new first class launching next week. The receptions that we're hearing from our top customers in the U.S. is extremely positive. And I think that's quite a unique market that we have within our group versus our competitors, is that France is a very attractive high-end leisure destination.
Yes, Ben, tell us a bit more about who is paying up to travel these days, because versus pre-pandemic conditions, I'm sure business travel not quite back to what it was, but there has been this boom in sort of wealthy leisure travel. Is that all coming from the States? Tell us who is paying up to travel.
The U.S. is strongest. We're seeing strength from Japan as well. Latin America, Brazil, quite strong. Some of the Mediterranean countries, Lebanon, countries where historically there's been good demand, but this city, I'm in Paris today, seems to be attracting a lot of wealthy customers traveling for leisure purposes. It's not just on airplanes; it's with the hotels, it's with the Michelin-starred restaurants. It's quite amazing to see. The rest of the economy in Europe is not experiencing that, but in particular, the hospitality industry here in Paris today is strong.
OK, heavy competition for tables. Ben, I want to talk about rising costs or just the cost base generally. On the one hand, we've talked about tariffs, and there might be some nervousness around costs across the industry and how they might be impacted by tariffs in the future. On the other hand, we have an administration in the US that likes lower oil prices and seems to be getting what it wants to some degree on that front. How are you thinking about your cost base?
Well, if we start with the aircraft, we were lucky, I think, timing-wise, when we ordered a significant new fleet of wide-body and medium-haul and regional airplanes back in 2019, 2020. So we're not subject to the same level of delays as some of our major competitors. We hardly have any Boeing aircraft on order. The bulk of our orders were with Airbus. We have not got the 777X on order, which is a great airplane. It's not yet flying, it's not certified, but it is a great airplane, but it is holding back some expansion opportunities for some of our competitors, refleeting of some of our competitors. From a cost perspective, I think because of that, our cost structure will be relatively better than our biggest competitors.
Yep.
But if you look at, when we look at ourselves versus where we'd like to be, obviously there's challenges in the supply chain. We have some aircraft delays, but fuel is today is offsetting a lot of those other those cost increases that we're seeing. But here, what you saw last year in the U.S. in terms of wage increases, we have not yet seen that here in France.
Okay. Ben, are you planning for the reopening of Russian airspace, and what would that ultimately mean in terms of your network?
Not yet. We're assuming that that this airspace remains closed. It'd be a pleasant surprise if it does. But we don't. Our exposure to that part of the world is not enormous. So yes, it impacts. It does give Chinese carriers an advantage. But right now, Chinese demand to Europe is still significantly down. So our capacity into China is not where it used to be in 2019. So the fact that we can't overfly Russia right now, look, it hits us, but it's not that material.
Ben, it's always great to catch up. Always a pleasure, sir. Thank you very much indeed. Air France-KLM CEO joining us from Paris, Charles de Gaulle. Ben Smith, thank you. Let's get back to the markets.
Yeah, let's get back to the markets. We've got bond markets certainly continuing to price in further fiscal spending here in Europe. We see that very clearly. Let's get to our Markets Live executive editor, Mark Cudmore, with thoughts on how the bond rout continues. Higher yields in Europe once again this morning then, Mark. I see German Bund yields are up 2.9% right now is where they are. That is the yield. It's not all that far from 3. Any sign that this stops anytime soon?
At the moment, absolutely not. As my colleague Dave Goodman just put in our internal IB chat, the way it works at the moment is you walk in, digest some incredible overnight news, watch markets do historic things, and then rinse and repeat. It really is kind of unprecedented times in markets across asset classes. At the moment, the last kind of 36 hours, it's bund yields really stealing the limelight, and these are major moves at the moment. I am slightly worried that markets are overestimating how quickly the ECB will incorporate these new spending plans into their projections. Certainly, we've priced out one full rate cut pretty much since the end of last week, so it's very, very rapid. And I think that these plans from Germany really are massive. I think this is really consequential news, and that's why I said yesterday I expected much more topside in euro dollar. I didn't expect it to happen quite so quickly, but I said that overall it's a theme to happen that's going to continue throughout this year or maybe longer term. This is a paradigm shift for Europe and for Germany. In the very short term, now we've got ECB going ahead. There's surely got to be, in the next few hours, some people tempted to take some profits on the incredible moves of the last couple of days.
Yeah, we have images of Christine Lagarde scrabbling to rewrite her speech ahead of the press conference. To your point, the ECB market's fading out their bets, now fully pricing in just 2 cuts. 108 on euro dollar, Mark. Talk to us about your comfort level for moves higher in euro. Where does that take you?
So, as you know, Tom, since December, I have, been bearish the dollar in terms that I think that the analysis around tariffs was quite misplaced. There was very much based on a theoretical analysis. They work in isolation, no reciprocal tariffs. I think that this year is going to be bad for a dollar that is very overvalued, and the world is structurally overexposed to US assets. So I think it's the end of the US exceptionalism in terms of markets, and that's very negative for the dollar because overpriced equities have been a large part of that flow. So I think the dollar weakens, and I think this news on Germany is structural for euro. I think people are going to be seeking to, at the margin, I'm not talking about the end of dollar as the world's reserve currency, but at the margin, they're going to seek to lower their exposure to the dollar, and as part of that, euro will gain. So I think over the coming years, I think euro dollar goes much higher. I think we're going to start talking about levels like 120 again, 125, 130. I think that's what ahead of us the next few years. Short term, I have no particular view. Short term, I think it's gone quite fast, quite quickly, and I'm a little bit nervous. But the longer term picture, this is a lot higher to go over the next couple of years.
It was interesting just listening to Ben Smith talking about the structural demand coming out of the United States, US tourists coming to Europe. You wonder at 1:30 how significantly that changes. Just very briefly, in 20 seconds, Mark, Can European equities survive a downdraft in US equities? What's the beta right now?
I think they'll get hurt a little bit, but you've got to remember these aren't as expensive markets. I think the general theme at the moment is in this world of greater uncertainty, greater volatility, greater risk premium across assets, you go to value. And there are many stock markets around the world that are heavily discounted. Europe's no longer that case, but it's not as over expensive. So it gets hurt, but not so badly.
Mark, great stuff. Thank you very much indeed. Bloomberg Markets Live Executive Editor Mark Cudmore. Remember, you can get all of the up-to-date analysis from Mark. The rest of the team, they come in, they look at groundbreaking, epic news, they write about it. And the analysis is fantastic, and you can find it on your Bloomberg terminal. MLIV.
I think we do the same. We
do.
come in, we
Believe
watch groundbreaking news, groundbreaking
Yeah.
market moves, we talk about them, we go home, we sleep, we come back, we do the same thing the next day.
There is a Groundhog Day feel about it.
There is, and I'll talk about autos, shall I,
Yeah.
in the theme of Groundhog. Autos in focus because yesterday they were up in the States on the back of a one-month reprieve on Mexico-Canada tariffs, and so we'll watch the European side of that, Stellantis, for example.
I mean, I hear in your tone, the question is that a rational move, given that this is just a 30-day, one-month reprieve? The tariffs could be kicking in again. It doesn't take much to think that the volatility around this question remains for the automakers.
Defence stocks are going to go higher again. I feel like I've said that before somewhere.
That's another Groundhog Day moment.
Yep, and airlines are doing OK on the back of US tourists.
Yeah.
Like that's another theme that's...
How long does that last?
Until
1:30 would change that dynamic.
That would change that. We'll be back with the opening trade. That's coming up shortly. This is Bloomberg.
Thursday morning, good morning. As soon as the European markets are closed yesterday, equity markets, US equity markets started to rally. You can see the low point hit just there. The rally needs to be priced in this morning. That is part and parcel of the rally that we are expecting to see in European equities. Tom's got the futures, and I'm telling you, they're green.
The European bull market continues with the eye on the prize around the defence spend, careening past those tariff risks, looking to add another 0.8% after the upside of yesterday. As you say, 0.9% across the benchmark on Wednesday. FTSE 100 futures pointing to gains of 39 points at this moment. And the DAX over in Germany looking to add 175 points. Will we get more details at our EU leaders meeting in Brussels on the defence spend and fiscal stimulus?
Yeah, absolutely. These questions hang over markets then. But in the meantime, we go higher, Tom. And as we wait for more clarity, of course, around the tariff story as it pertains to Europe, let's talk about a couple of sectors and one stock that could be on the move this morning. Aviation certainly in focus. Lufthansa talking about 2025 as a transition year. How will that play out for them? Air France-KLM, a bit more positive, strong demand across the Atlantic, talking about their cost picture being better than some of the competitors because of the way they've ordered aircraft. Autos in focus as well as they get a one-month reprieve on those tariffs in North America. So we'll see how that plays out for autos in Europe as it did for the US. They certainly went higher in the United States on the back of that news yesterday. And Reckitt Benckiser is certainly an interesting one to keep an eye on. This, the home supplies business, fourth quarter like-for-like sales coming in a little bit lighter than the market had anticipated. 4.6% on like-for-like sales growth is lower than they had expected, than the market had expected. But they're talking about another year of adjusted EPS growth, Guy.
Anna, European equities year-to-date have added over $1 trillion in value. Yes, bonds have given some of that back, but European equities are certainly higher, and we're expecting that to continue. OK, Thursday's opening trade is upon us. Let's take a look, ring the bell, figure out what is happening. The FTSE 100 is up by 0.1%. It is expected to climb. Clearly, there are going to be some individual areas that we're going to keep an eye on what is happening in the oil space as well. But airlines this morning are in focus. Defence stocks remain firmly in focus. This key meeting that we are going to be watching out for. Got a series of names coming through with numbers this morning. Take a look at what is happening with Schroders as well this morning. We're going to be speaking to Merck a little bit later on. There are a number of earnings numbers that we need to focus our attention on. But the big picture macro story remains, it seems, in charge. The CAC is up by 0.6%. It is outperforming this morning. The IBEX is up by 0.3%. We await for Germany, as we do every morning, but it has been at the forefront, the vanguard of the story in Europe over the last few days. In fact, so far this year. So there we are. We're up by, let's call it, circa 0.5% across Europe thus far, without the DAX having already opened. Tom, what else are we looking at?
across your sectors and as earnings and as the equity story in Europe continues to look through higher yields and the sell-off on bonds, when does that story start to adjust? Currently across your sectors, energy, to your point around oil prices, currently up 1.1%. Though, of course, oil in the last few weeks has been under pressure. You're seeing a bit of a gain coming through for Brent and WTI in the session. Tech also getting a lift up close to 1% as we wait at the DAX, with the focus, of course, on the auto sector on the back of the tariff story and the adjustments there around a reprieve at least for a month in terms of the automakers from Canada and Mexico. Currently, tech up 0.9%. Travel and leisure, to your point around the airlines, getting a lift up 1%. Energy still top of the list across your sectors on the downside. Utilities, personal care and healthcare.
Yeah, real positivity around the aviation sector, then it would seem, looking at some strength out of Air France-KLM. So that's one of the stocks that drives that travel and leisure move.
Entain also is up sharply higher within that space as well, more on the leisure side than the on the travel side. So you're certainly seeing some gains coming through there. In fact, from a percentage point of view, it's the second best performer out of Europe. Ellis, the only stock that is outperforming it. In terms of where the heavyweights are, it's interesting to see there is some dividend in the market this morning. So I think HSBC goes ex-dividend this morning. It is down as a result of that. I think some of the miners are also clocking a little bit lower. But Pharma giving back a little bit of ground, and Reckitt down by 2.5%.
We were speaking to Schroders earlier, and the CEO, of course, that company currently up close to 4%. The earnings story filtering through on Schroders, of course, in terms of asset management, AUM. A bit of a pickup there. They focus on the wealth business. The DAX still waiting for a print there. Here in the UK, the FTSE 100 currently flat. Over in France, the KgaA gaining 0.6%. Just checking your sectors again. It's travel and leisure now top of the list, gaining 1.4%. Autos opening higher as well, as suspected, of course, gaining 1.2%. But there's been volatility there, linked, of course, to the adjustments around the tariff story.
Yeah, and does this growth in Europe mean that rates stay higher for longer? Markets adjusting their ECB expectations, and I see real estate is the worst performing sector today, so that would fit with that theme. Let's talk about where we are in markets. Bishwan Zhu joins us, a global equity fund manager at Royal London Asset Management. Really good to have you with us this morning. Another busy day. They're all busy these days, aren't they, Bishwan? Let me ask you about your outlook for European stocks broadly, because it's just, I mean, yesterday this whole story took on another complexion, had another meaning, but infrastructure in Germany, defence spending across Europe seems to be the place where a lot of people are excited right now. How excited do you get to play those themes?
Yeah, so I think there is a short-term picture and there is long-term picture. In the short term, the valuation across the European equity is still unassuming. And just let's remember, Germany and France, two major economies, were still in recession, so the stimulus is going to be able to trigger cyclical return, and that's going to be positive for the European equity. But the long term, I think the biggest question is growth. So is Europe going to be able to generate growth? And I think that's not straightforward. If you look at the big picture, actually Europe has more challenges than before after the Trump presidency. There's a cost factor of defense. So that's for us to see. So we think it's too early to say there is a macro story in Europe yet.
OK, really, that's interesting. Is that because the things they spend money on, defence, for example, you know, in the short term you might need to spend it on US defence companies, not in Europe. Does it come down to how much of this is infrastructure spend in Europe as to whether we get that growth multiplier?
Yes, exactly. So the kind of sea level changes, Europe has to take care of its own defence and pay for it. And the reality is Europe can't quite take care of its own defence yet because it hasn't quite the supply chain. So a lot of those orders will need to go to US. They will land in the US in the kind of near to medium term. And also, who is going to pay for that, right? And let's not forget, over the last year, all the incumbents were nearly voted out, and the extremism is on the rising. So you need to kind of finance the warfare state from the welfare state, and that's not a straightforward line. So the growth, is Europe going to boost the productivity and growth? That's really the long-term big question, and that's not straightforward.
Funding the warfare state with the welfare state. You talk about the relatively benign nature of valuations in Europe. Does that apply to the defence sector? What is the strategy around defence if you don't already have exposure in that area right now?
I think right now, if you look at over the couple of last weeks, the US stocks, the industrials, have come off quite a lot. And if you think about where the defense money will land, a lot of that will lead to higher industrial activities in the US. So I feel that's an interesting area maybe to take the valuation opportunity and to add. And also if you look at tariff, right, so there is no way to predict tariff. But if you are a corporate, you are not able to predict that as well. What you would do is, if you are considering your next CapEx project, you are more likely to do that in the US. Again, that leads to increasing US industrial activities.
Does that suggest that the question marks about US exceptionalism are slightly overdone? Does the US exceptionalism story have further to run, despite the softness in some of the data that we're seeing?
From a long-term perspective, the US fundamental is less challenged than the other regions. So I think some of those exceptionalism is valid. But I think that this market reaction we had was also rational, because it was very much like how much this exceptionalism was priced. But now we have more room to... Yeah, we had a repricing of the US market slightly.
The US economy has outperformed over the last few years in no small part due to the fact that the fiscal spend has been enormous and European equity markets have been in its shadow. Now we've got a situation where we are going to see significant spending in Europe. Why do we not get the same results and European equities go higher as a result of what is happening on the fiscal front?
So at Royal London, we rarely invest just based on macro story. For example,
Okay.
our positioning, we were overweight Europe, although we were very pessimistic on the macro side. But that's just a result of the kind of mispriced cash flow we just saw in the European domestic business, in the industrial business. There was a long-term mispriced cash flow, and that we were overweight.
Sure.
So we think it's more important just be really selective, instead of saying structurally go long US, or now we switch to structurally go long Europe. In this type of environment, what you definitely have is higher interest rate volatility, and you want to build up a portfolio that can fend you off that. It's kind of life cycle diversified, so you have something that works well in a kind of high rate environment, you have something work well in a growth environment, and you blend
Is a diversified portfolio going to underperform again? Because that's been the challenge. It was a challenge when the US was outperforming. If you don't have European defence stocks right now, you are underperforming. How, as a portfolio manager, do you make sure that you can keep up with some of these moves? What do you need to do to make sure?
Yeah, with diversification, we mean like very high stock-specific risk. So you really make sure you discount for those uncertainties, and you really pick single stocks that...
Is that easy to do right now?
I think that's actually a great opportunity for active stock pickers, because those volatilities goes on, and that really, if you are very clear about what you want to buy, and that more often gives you the right price to buy than less. So we are actually quite excited. Change is good, and a lot of change is happening in Europe.
Yeah. Certainly a lot of change, yes. Yeah. So what's most mispriced versus your expectations? What looks like it's I don't know, babies being thrown out with bathwater, or, you know, something that looks really wrongly priced right now, a good opportunity that you're looking at?
I think some of the mature industrial companies in the US and Europe are still mispriced. Because people think they don't have pricing power, etc. But if you think, and some of them are really good capital allocators, and in an inflationary environment, they would have the pricing power. And in a tariff environment, they have a changed pricing power, because you need to buy from them rather than import. So we feel like some of those mature, kind of late life cycle industrial companies in Europe and US remain very attractive.
Why do you have more faith in their pricing power than others in the market, do you think? What's causing that divergence of views on whether these big companies have pricing power right now?
I think that's slightly a different dynamic in the US and Europe. So in the US, it's basically the result of years of outsourcing and offshoring. So that you have a very consolidated market, and where the supply is very disciplined. So this industry structure, we feel, is underestimated. And for Europe, I think that's just the kind of payoff, the kind of how the cash flow is priced for some of those mature industrial companies remains quite large because people just stream to the defense companies, etc. But then actually the input players into those companies, they remain quite cheap.
What's the potential pain point that you'd be watching for when it comes to higher rates in Europe as we look at yields jumping and ECB cuts being faded out by the markets?
I think leverage is definitely a pressure point we need to look at, because this is the kind of spending extra 500 billion defense spending from Germany and another 500 billion infrastructure spending. They're not funded. So will that lead to higher financing costs among the European corporates, especially small and mid-cap? So we saw that during the COVID crisis, when the supply chain, the energy prices bankrupt so many companies. So just beware of the balance sheet risk.
Does there come a point when the sell-off in the bond market derails the upside for European equities?
Yes, in the medium term, if Europe cannot show that those reforms are leading to higher growth, higher productivity, I think that's likely to happen. That's why I think there is no straightforward European growth story yet.
Bishwan, that's a really interesting angle. Thank you very much indeed for sharing it with us this morning. Bishwan Shu, Global Equity Fund Manager at Royal London Asset Management. Core 6 looks like this. This is the picture we are looking at. There's significant moves this morning in the aviation space. We are watching LVMH also go higher, ASML go higher. Else there is some weakness out there this morning. It's interesting that the pharma sector certainly is under a little bit of pressure. Let's figure out what else is happening. Joe's here with the details.
Big movements, Guy, in these airline stocks today, specifically in Air France. Take a look at this one. It's up almost the most in 5 years now for that stock. It was in and out of a trading hole. It was up around 17%, opened up back now. We're up around 13% on that one. I've been asking traders in my chats what's going on with that one. They're pointing to the cash flow. The leverage seems to be improving at the French company, given they do have a big debt load. That seems to be easing now, and therefore the stock coming back up, actually continuing a decent gain. And also Lufthansa rising as well, pretty strong numbers out of the German airline, really. But Air France, the star of the show in the airlines today, a massive jump for that one. Then also in the logistics space, similar sector, we've got DHL moving, the company announcing a buyback, and also they are trimming some of their costs. This seems to be feeding through into capital returns for the company, so another decent gainer for DHL. We will eventually get that one on the screen, I'm sure, but you'll have to take my word for it. DHL, we've got it down the bottom there. We're up almost 10% for that one today. Then we've also got Reckitt Benckiser. Don't think I'm going to have much luck with that screen. There we go, Reckitt. We've got that one. We're down 3% for Reckitt. Once again, weak sales, weak like-for-like growth for Reckitt. Not selling enough Sillet Bang, of course. And also, it is looking like the vaccine and some of their other healthcare drugs also looking a little bit weak. So the organic sales at Reckitt missing once again. More weakness for that stock. It's had a bad run over the past couple of years, of course, for Reckitt. Then in terms of gambling, Entain really strong in the US. All that NFL betting boosting the company. We're up 3.5% for Entain today. The owner of Ladbrokes as well, but got this big partnership with MGM in the US, so that one getting a boost. We're up 3.5% for Entain. Then over to the stock of the week, Eutelsat. Of course, the company did speak to Tom earlier as well. Now, this stock traded at the end of last year at €1. We're at €8.25 on Eutelsat. A huge jump. We're up another 5%. It doubled yesterday. All the news on Starlink, of course, boosting that one. And then finally, finishing on airlines where we started, but this time Ryanair. We're getting a downgrade from Morgan Stanley today, which says the valuation is too full on that one, and also seeing some increased costs, mainly related to fuel, according to Morgan Stanley. So come down to equal weight, but it does look like airlines getting a positive read from those Air France and also the Lufthansa numbers. So that one actually higher, but Morgan Stanley no longer a buyer of Ryanair. The stock's still up 1.6% this morning.
Joe, thank you very much. Joe Easton from our equities team. Tom, throughout the last hour of the programme, we've had a sort of drip feed of lines coming through from China. We're getting through the NPC, all these important meetings taking place in China. Yep. And today, monetary policy seems to be to the fore. We've been hearing from the PBOC. and a big tech theme coming through this.
Yeah, yesterday at the National People's Congress, that's where they outlined the broad themes in terms of how they want to direct this economy from the Premier. Today, you're getting some details, as you say, from a press conference where you have the Finance Minister and you have the head of the PBOC, amongst others, giving detail. And they're putting money where their mouth is when it comes to that lean into tech. We've seen all the excitement about DeepSeek, and today Alibaba as well with a new model. And now it seems officials are wedded to the idea that AI innovation can be part of the solution in terms of reviving the growth outlook for the Chinese economy. And Peng Gongshang, the PBOC governor, saying they're going to expand tech re-lending to 800 billion yuan from 500 billion, and also lower some interest rates as well around re-lending when it comes to the tech sector.
What are they doing with the consumer? How do they get the consumer going? Seems to be the biggest challenge that China faces right now.
That is a much bigger challenge than the overall impetus and catalyst around tech, at least for now, for China. And interestingly, and we have some reporting on this from the Bloomberg today about how the pressure from Trump, not just in his second term, but in the first term as well, 1.0, not 0.1, has led to a focus from policymakers in China to revive the consumer, to try and support the consumer around and away from manufacturing and exporting. They still have a lot more to do on that, but they have stressed that, and they did stress that in the language yesterday in a work report from the National People's Congress. Now that needs to be implemented as ever. But the consumer drive, they've woken up to the fact they do need to enliven the spirits of the consumer in China.
Yeah, absolutely. So we focus on whether we get more fiscal stimulus out of China. Coming up, we bring you an exclusive conversation with the CFO of Germany's Merck after the drug to semiconductor firm. It does all of those things. Forecast slow profit growth for the year. That's next. This is Bloomberg.
Welcome back. Shares in Germany's Merck KgaA trading high up this morning after reporting earnings, saying it sees slow profit growth this year. This is the company's life sciences unit, continues its recovery, while its semiconductor division sees growth from the AI boom. Joining us for an exclusive conversation is the CFO of that business, Helen von Roeder. Helen, thank you for joining us this morning. Talk us through what stands out to you from the results, how it sets the business up going forward. Slow growth, where are you in recovering from part of that COVID slump?
Hey, good morning from sunny Darmstadt. So overall, I mean, 24, we ended up pretty strongly on profitable growth, delivering on our guidance. And what we're seeing is a very strong year-end, especially in Q4. All three businesses went back into profitable growth. And that's ultimately what our guidance is about for 25. We are very confident in the future. We do see that growth theme continuing. And as I look to the three business sectors that we have, life science, process solutions, coming out of destocking, coming out of the COVID issues that we had, and basically going back into our midterm guidance trend. Healthcare delivering, as we know, and as we continue profitable growth over our established and novel portfolios. And then, of course, electronics benefiting very much from the continued AI boom.
Helena, good morning. It's Guy. A 25 billion euro sales target was talked about, and it was potentially going to be reached this year. How far away is that target right now?
So if you think back when the target was issued, that was issued during COVID heights. It was pre-Ukraine war. So overall, I think 2 years ago, we even took down the target because ultimately it was something that we had issued in the past. If you look at our guidance, definitely 25 is not a year where we're going to deliver the 25 billion. I think that's fair to say.
OK, so you won't get to 25 in 2025. Good morning to you, Helen. Let me ask you about semis. You mentioned that the AI boom is helping, of course, the semiconductor part of the business, the electronics part of the business, and that makes sense. But in the broader semi space, what can you tell us about that? Because there's the AI side and then there's the sort of broader, more consumer-facing side. How's that performing?
And indeed, that's a market of two stories. Number one, you have the AI side, you have the advanced nodes where we are very well positioned and we're seeing double-digit growth in that area. But then you have the sort of broader market where, on the back, in my opinion, of actually pretty weak consumer demand still, we're not seeing the recovery we had hoped for and that normally you would see at the end of the semiconductor cycle. Most people and experts you talk to is right now targeting a H2 recovery in that sector, let's see. I mean, you also had a few news out on China, the China consumer. Let's see how the US consumer is behaving to see to what extent that market return will accelerate or not.
Helen, what are you doing in terms of the tariff impact? How concerned are you about tariffs, and what specifically are you as a business doing to mitigate some of that impact?
So we're a 350-year-old company, and we've been dealing with a lot of uncertainty during our tenure. Overall, we are basically relentless focused on customers and our clients globally and delivering for those. What we have done in the past and over the last couple of years is to really make sure that we spread our CapEx across the regions that we serve. You may know our business is more or less a third Asia, Europe, and the US. And we've now really localized our supply chains. We've really localized our production facilities. And as a result, feel we're very well positioned around the current geopolitical tensions. All of the CapEx and all of the uncertainties are very much a CFO bonanza because, I mean, we are scenario planning left, right, and center. And I can tell you the answer is agility and reacting to what comes our way.
But a lot of uncertainty, and it's amazing that we've seen suddenly Germany becoming the epicenter of a growth story in Europe, the government potentially spending significantly more money, infrastructure spending, defence spending. Does that change your perspective once again? It's another big surprise, and I'm wondering in your home markets, in Darmstadt, how that potentially could be felt. As a senior leader at a large German company, how are you viewing this?
Overall, I think we are really looking at Europe with a massive potential. The thing is, like, we as Europeans need to get together, and I think that's happening right now. Europe is really understanding what its role in the global orchestra is and how they need to deliver. So I'm super confident and super positive around politicians, society, but also the economics pulling together and making sure that we finally deliver on what Europe's promises. So I'm actually quite excited here.
You say you're a third in different regions. Will you be more Europe, Hélène, soon?
Overall, as I said, it's like we service a global customer base. And per se, we are seeing opportunities across all three regions. So at this point in time, I'm not sure we're going to pivot one way or another. Because all three markets and all three segments offer very strong opportunities for us. Don't forget, we're very much centered in megatrends of this globe. And they are more or less across the globe the same way.
OK, Hélène, thank you very much. Thanks for joining us. The CFO of Germany's Merck, KgaA, that's Helen von Roeder. Thank you very much for joining us. We will stay in Germany with the ECB in mind. Coming up, the European Central Bank is widely expected to cut interest rates again today. That'll be the 6th time since June. We are going to go to Frankfurt. We'll get a preview because even if today looks pretty simple, where we go from here looks less so. And a lot of economists and others very divided on what we are going to hear for the rest of this year from the ECB. This is Bloomberg.
Welcome back. This is the opening trade. We are 30 minutes into today's session. The gains coming through on European stocks being faded somewhat, just up 0.3% after a solid day yesterday. Of course, the tariff news, the adjustments around the auto sector, but the continued focus on the defence spend. Here in the UK, the FTSE 100 actually down 0.5% at 8,712, but a decent session over in Germany. The DAX up 1.2%. We lead up, of course, to the meeting as well. And the decision from the ECB, the European Central Bank, is poised to cut interest rates today at a time, of course, when the bond selloff continues and yields are up. For the 6th time since June, the volatile economic backdrop is sowing divisions over the path ahead. Traders now favouring just 2 more rate cuts by the ECB this year. That adjustment coming through. Let's go to Lizzie Burton, who's on the ground for us in Frankfurt with a preview. A cut fully expected then, Lizzie. What else are you going to be watching for today?
But it's all about the path ahead, Tom. And even before all of the tariff news and the defence and infrastructure spending news, I'd have told you that anything could happen after April, because analysts are divided, the Governing Council is divided. One analyst says that today could be the last cut of the cycle. Other analysts are saying that you could have cuts all the way to 1% by January 2026. And it's because, if you listen to the ECB Governing Council, some of them are still worried about sticky services inflation and higher energy costs. Others are worried about sluggish growth in the euro area. But this week we did get some encouraging data on the inflation front. We had services inflation falling below 3.9% for the first time since April 2024. In the fourth quarter you've had a bit of easing on the wage growth front, and both of those things can give confidence to policymakers maybe that actually they will get inflation back to that 2% target in the coming months. So I'd say the big tell for markets is going to be, do they drop the language that describes policy as restrictive? Because if they do, that would be seen as an indication that actually there's going to be a pause in these rate cuts or maybe an end to these rate cuts. But if they don't, that would be read as a big signal that another cut is coming in April.
OK, so we watch that use of language very carefully, Lizzie. Economists seem divided on where we go from here. Governing Council members seem pretty divided on where we go from here. And the German fiscal boost just coming this week, that must change the calculus a little.
Totally. I'd love to be a fly in the room for this meeting, Anna, because it is seen as a paradigm shift. There was a historic move in markets yesterday on Bunds, and lots of analysts binning their euro-dollar parity predictions. But crucially, as you said earlier, traders paring their bets on ECB cuts for this year because they see a boost to growth from this. I think it's Goldman Sachs sees a 2% boost to German growth off the back of this, up from 0.8% for next year. And so if we look at that, actually it means that you need to pass what comes out of Brussels in this European Council meeting. But in the press conference, I'm sure Christine Lagarde is going to be asked, what is the ECB's role in response to this? Economists at Allianz are saying if you've got heftier budget deficits, if you've got spreads widening, do they need to come back and restart these large-scale bond purchases through the transmission protection mechanism? You need to weigh that with the tariff threat, but I am sure that the ECB will be telling you we don't make policy, we don't make projections off the back of threats, and at the moment that's all Donald Trump's trade tariff threats are.
Lizzie, thank you very much. Bloomberg's Lizzie Burden in Frankfurt, of course, and we'll bring you full coverage of that ECB decision from 1:15 London time here on Bloomberg TV, with the ECB President Christine Lagarde's news conference coming at 1:45. So much to talk to her about during that news conference.
Absolutely. Let's continue the preview of what we are expecting in Frankfurt a little bit later on. Moritz Kramer, Chief Economist and Head of Research at LBBW, joining us around the table. Good morning. Nice to see you.
Good morning.
Does Christine Lagarde have enough information to make the right decision today? We don't know what's going to happen with tariffs. German spending plans are being unveiled, but there's a lot of kind of uncertainty around all of that. Everything seems to be in flux right now.
Absolutely. I mean, economists always say that the forecast is very uncertain.
Yeah.
This time it's really true, actually, because we're seeing huge shifts both in the international trade arena, but also what was announced from Berlin this week. I mean, these are very big moves, which are very hard to price. So today the cut will come, but what will also come today is new forecasts from the ECB staff. And I would expect that the forecasts are going in the wrong direction, meaning that inflation is probably going to be ratcheted up a little, and growth is going to be moved down.
How wide do you think the fan chart on the available kind of information are at the moment? How wide do you think the jaws are? The kind of, what do the tails look like, and how important are those tails?
Well, some observers would now speculate they were almost done. I think that's probably not right.
Right.
We have the discussion starting, probably triggered by Isabel Schnabel, and that's a good thing. You need to have this conversation. You cannot just go on autopilot meeting after meeting after meeting. But that doesn't mean that we're there yet. So I think there's still a couple of rate cuts left. And partly I say that because I believe in Donald Trump, not in him as a person, but as actually doing what what he's saying he's doing. So I would firmly expect that some sort of tariff threat will materialize. And for an open economy like the euro area, that's a big deal. So, so we will have sort of more dampening pressure on prices, on wages, because the real economy is subject to downside risks.
Maurice, does that mean, good morning, so from what you said there, do I conclude that you think the negatives from tariffs are bigger than the positives from European fiscal spending? Because this week we got really excited about possibly more growth in Europe, but you're saying actually you think the ECB will keep cutting because inflation won't be a problem. Is growth going to underwhelm because of tariffs as well?
It's a matter of timing as well. I think the tariffs will act much faster than the fiscal expansion. And the fiscal expansion, we're really talking about Germany here. So we need to, I mean, I welcome sort of the reform of the debt brake. I've been calling for that for a long time. I don't think it's a necessarily good idea to borrow for defense, because that's a consumption expenditure and that should really be paid out of current revenue. But so the investment will be ratcheted up, and that's absolutely necessary. I mean, infrastructure in Germany, digitalization, schools, universities, waterways, rails, etc. There's been so much that was underinvested over a quarter of a century. So this is high time that this is being done. But let's not believe that this is starting tomorrow. I mean, this takes a long time. You have nothing shovel ready, really, to that extent. The companies, the construction companies don't have the capacity. And what we also need to address is the complex mechanisms in actually getting the money out of the door from the budget. Remember, we used to have a debt brake, but we also used to have surpluses. So it was not a matter of money alone. The money was there, but it was too complex. So every year, money was left over in the capex budget of the government. So they need to work as well and just becoming more agile in spending.
Okay,
and only if that happens, I think next year we might see some positive impact. But what I just heard, 2% extra growth, I think if you believe that, you're set up for some disappointment.
Because it's just going to take longer, to deliver, I suppose, is what you're saying. When you look at some of the well, we haven't got a lot of detail, maybe, on the German spending plans yet. But in terms of the balance between spending on military and then spending on infrastructure, what are you assuming will be the multipliers of this fiscal spend into growth? Because if it's all military, in the short term, maybe it goes to the United States, but it isn't all military. There's a lot of infrastructure spend as well. So how much of a multiplier should we factor in?
I would think the multiplier from the military side is less, partly because there's no free capacity in the defense sector. If you look at the order books of the major European defense manufacturers, they are full. They have a pipeline of 2, 3, 4 years, some of them. So some of it will have to be imported, yes, and that actually detracts from growth. So that's actually a negative to growth if you import. So the multipliers will be much larger for infrastructure investment, and that's the nature of the game, because it's investment. So investment creates future returns, and it's perfectly fine within the limits of reason to borrow, because you will have these future returns. So that I see quite positively. I think if there is credibility and if the construction sector can actually prepare for this, and it's more than and it's set up for 10 years. That's very good. That gives companies a lot of visibility. So that's going to be the bigger issue.
Maurice, you're saying you do take Trump at his word when it comes to the threats around tariffs for Europe. What are you modelling in terms of the economic impact specifically of those tariffs?
Much will depend on whether Europe will retaliate, which it will probably be doing in part. So the estimates that I would endorse would say that probably if you have a 25% tariff, which is sort of the announcement that he made, and this comes sort of April, say, which I think is a plausible scenario, we would probably see growth declining in Germany by 0.5, a little less for the euro area overall, because the euro area is less dependent on exports to the US. But that would push even the euro area close to recession, and that's to come back to the beginning. That's why I think that the ECB is not done yet.
And you think the ECB gets below 2% by the end of the year?
No, I think 2% is probably where they're going to land. But again, the uncertainty is such that I think it would be unwise for Christine Lagarde now to give, and she will not do that, but to give guidance on where they will land. But I would not endorse views that say we go to 1.5 or 1. That would require really a calamitous recession that's currently not on the horizon, even with Donald Trump in the wings.
German bond yields rocketed higher yesterday. The rest of Europe rocketed higher yesterday in terms of its yields. Germany doesn't have a debt-to-GDP problem. Many other countries do have a debt-to-GDP problem. Is the ripple effect out of German spending into higher yields elsewhere going to cause problems in places like Rome?
It's certainly not welcome there. I mean, that's the irony of it all, no? The rest of Europe has always been calling on Germany to create more demand and reduce the trade surplus. Now they're doing it. Now it's negative as well. So, you have got to take one or the other sacrifice. So I think this will heighten the pressure on sort of weaker sovereigns in the euro area from the market side, not so much from the rating agencies, but from the markets. And on top of that, we also have, of course, the initiatives to loosen sort of the conditions of the Stability Pact for allowing more spending on defense. So, you know, the markets don't really care whether it's inside or outside. The limit, it's there. It's debt, it's debt, it's debt. So I think that is a risk. And we still have a situation where cheap bonds are being refinanced at much higher coupons. Now the coupons are going higher still. So that will create really pressure on the budgets. And if we carry on like this without sort of having a vision on how to rein in deficits, not only in Italy, I mean, you know, France is the bigger beast even probably on this. It's not going to end well. So we need this plan. Now there are other urgent things to address, like defense. What are we going to do without the US? And that requires more spending. And again, my preference would be to have some sort of revenue-raising mechanism, like a solidarity surcharge or something like that. But that's probably politically infeasible. So there will be more debt, but we must not have this as an open-ended window of increasing borrowing.
Yes. So is there something that Germany will be under pressure to do, Moritz, to make this pain less for France, for Italy, in terms of higher yields? Well, that might not be the right way to phrase the question, but how does that political pressure come to bear?
Well, that would mean that you have that you borrow less, right? I mean, it's a supply and demand issue. So we have had this huge move in the bond market yesterday because of the expectation that the supply will go through the roof from Germany, which probably is a bit of an exaggeration. This will be much more gradual. But that would also mean then that if you borrow less and give relief to France and Italy and others, that you spend less on defense, for example, or less on infrastructure. So you've got to have it one way or the other.
Do more joint debt? Does that help? Also politically difficult?
I mean, that's obviously something that the French want because they have little fiscal wiggle room, if any. So the experience, I would say, with Next Generation EU is not so compelling that you need to do this for defense as well. And for Next Generation EU, you had some investment spending where you could argue that the returns from this investment will actually help to pay back the debt. This one, you know, on defense, this is no payoff unless you're sort of planning to have a war of aggression and exploit the other countries, which I don't think is currently what we're looking at. So, no, I think joint issuance may still be in the discussion, but it looks more like that we're going towards sort of more generous wiggle room on the deficit rules.
OK, certainly being talked about in Brussels today, then. Thank you very much. Moritz Kramer, Chief Economist and Head of Research at LBBW Bank. We thank him very much for coming to speak to us. So it'll be a topic of conversation at the ECB, of course, Guy, and then in Brussels, where EU leaders are meeting. Yeah, we've got a council meeting taking place today in Brussels, leaders meeting to talk about what they are going to do next. An emergency set of talks designed to push through and mobilise this defence spending that we've just been discussing with Moritz. We are live in Brussels next. Yesterday, we heard from Ursula von der Leyen. Today, it's going to be interesting to hear what the leaders have to say. That conversation is next. This is Bloomberg.
In response to the historic appeal of the future German Chancellor, I have decided to open the strategic debate on the protection afforded by our deterrent to our allies on the European continent. Whatever happens, The decision has always been, and will remain, in the hands of the President of the Republic, head of the armed forces.
The French President Emmanuel Macron addressing his nation last night ahead of today's EU leaders' special summit, emergency summit, on the subject of defence and Ukraine. Let's have a look at how some of the companies that are connected, of course, to this defence story are trading today. We've seen weeks of slowly pricing in and then days of very quickly pricing in faster defence spending, more defence spending here in Europe, and that continues to some degree today, although at slightly slower pace for some names than we've previously seen. Melrose, on the other hand, we spoke to Peter Dilnot, the CEO of Melrose, earlier on. That stock now down by 11%. Perhaps sticking to guidance, Guy, was the line you were mentioning.
There's been a huge ramp up in the stock. They basically confirmed guidance. Was the market hoping that guidance would be raised?
Yeah.
He was a little bit more cautious on that. He's talking certainly about quite a positive defence picture going forward, but they stuck to guidance. Is that what is causing maybe the unwind of the recent rally?
And defence, 1/3 of their business, as he pointed out to us. Let's stick with the defence theme then. Bloomberg's Oliver Cook is in Brussels at that EU Leaders Summit and can give us a sense of what to expect. What are we going to hear today? We already heard from Ursula von der Leyen earlier this week, of course.
Yeah, so listen, Anna, if there's been a wake-up call since November that we've been hearing from European leaders, as they've been repeating to us since then, this is really the week where Europe got out of bed, right? So everything from the EU proposals, what is going to be discussed today is some of the things that were unveiled by Ursula von der Leyen earlier in the week. We should just remind our viewers of what those are. About 150 billion euros worth of direct lending from the EU, another 650 potentially being unlocked by basically easing fiscal rules across EU member states in order to basically be able to debt finance without any consequence defense spending. And we should also say that the really largest sea change here, yes, it is at the European level, but it's really fundamentally the thing that is driving things is at the German level. We have a German chancellor-to-be who is actively lobbying. The German chancellor that's coming in is actively lobbying to the EU to loosen fiscal rules. This is a seismic shift from the Germans. We're talking about establishing funds, working around the debt brake, potentially nearing, it could 500 billion in terms of the infrastructure fund, maybe several hundreds more in terms of defense. That is really the moment here, and this is Germany really waking up, beginning to flex its fiscal muscle. And you have to sort of plug this into the bigger picture here. Generally, on a day like today, when we think about the markets, we look to the ECB. We think about what the ECB is going to do. We are now shifting to a world where it's from monetary policy driving the markets to the fiscal policy driving the markets. I mean, what could the ECB possibly do to move German borrowing rates by 40 basis points in 2 days? Never has happened in the past. It is now a fiscal story.
Yeah, and what lit the fire, arguably, was, of course, the fallout, the very public fallout between Trump and Zelensky of Ukraine. Yesterday, of course, the US cutting off intelligence flows to that nation. To what extent, is that being seen as just a leverage, a point of leverage for Trump, or is it seen as something more concerning for Europe, for Ukraine, and how Europe responds?
I mean, listen, I think it's this is the sort of key to negotiation. It's being seen by the Europeans as both, right? It is actively going to have damaging consequences for the Ukrainians in their war efforts. Of course, that follows the halt of arms that are now basically not being delivered anymore to Ukraine. But it's also just one of many levers that Donald Trump can continue to pull if he wants to exert more pressure on President Zelensky. President Zelensky, who will be in attendance to some of these meetings a little later today, he'll be in Brussels to discuss with European leaders. And the real question is, and unfortunately, it's a question we've been posing for a very long time, and the answer may be not a whole lot more, is what can these European leaders do in terms of actively delivering, in terms of hardware, to supplement what we've had from the United States. We've heard from European officials that basically there's enough hardware from the European side to continue to support Ukraine basically until the summer. But at the end of the day, the wake-up call that arrived for the Europeans may have arrived a little too late for Ukraine, for whom it will take many years to develop a lot of the infrastructure and the hardware that needs to be delivered. But again, we'll see what they can come up with in this meeting.
Ollie, great stuff. We'll look forward to the details and the coverage a little bit later on as we work our way through the day. ECB Council meeting, 2 big events taking place in Europe. The bond market continues to react to all of this. Bunds continue to climb higher yields. Bunds continue to sell off with higher yields, probably is a more accurate way of putting that. Valerie's here with all the details.
Yeah, what a day it is. Like we're headed for maybe another double-digit gain to the bond yield today, getting very close to 3% on the German yield. And my question is, you know, are there other countries out there who are going to be struggling with this current rise in yields? One of them, in my mind, goes to the UK, who's already promised more fiscal spending when it comes to defense, has not promised very much when it comes to cutting other spending programs on the back of it. But thankfully, the OBR has likely already taken their snapshot of the market for the spring statement later this month. So maybe Rachel Reeves gives a bit of a reprieve there, that this recent rise in yields won't necessarily eat into her fiscal headroom on paper when she does make that spring budget. Well, the other thing from the Macron address to the nation yesterday is he ruled out raising taxes, meaning that this extra defense spending that France is going to want to do has to come alongside cutting welfare programs. Else, I really think you're really pushing the return of the bond vigilantes when it comes to France and the UK.
Yeah, that could be really interesting, because even if Germany has the headroom and the bond market's quite relaxed about that, as it ripples across Europe, it can have unforeseen or very foreseen consequences, I suppose. Interesting to see, and yeah, we spoke to a guest earlier who was talking about warfare needing to be paid for with welfare, and so that starkly illustrates the choices that are being made by various governments. Interesting that stocks are actually flat now in Europe, Valerie, raising their gains. Stock 600 is flat, US futures pointing lower. Wondering where the session from here goes, because we've been talking about some trends that are a couple of days old now.
Yeah, well, OK, I think the one big thing for the market is Lagarde's tone this afternoon. Does she reflect any of this market exuberance in her speech, or is she still going to be constrained, talking about caution ahead, maybe mentioning the tariff war in the path ahead? Because, you know, the market might already assume that some growth impact from these fiscal spending programs could be baked into their forecast. But if Lagarde doesn't today, because she says maybe it's too soon to take that into account, she'll spin a dovish message, which means, I mean, euro could be at 110 before we know it, right? If she maintains the fact that they still want to cut, that they see caution ahead, that they're worried about GDP growth, not necessarily worried about inflation, and those cuts are back on the table all of a sudden, you know, you could see the European currency definitely take another leg higher if she maintains that old line.
Some European exuberance. Valerie, thank you very much indeed. Let's carry on with that kind of European exuberance theme. We spoke to the CFO of Merck a few minutes ago. Listen to this exuberance.
All of the capex and all of the uncertainties are very much a CFO bonanza, because, I mean, we are scenario planning left, right, and center. And I can tell you the answer is agility and reacting to what comes our way.
Excited. Expecting to see more. I think she went on and was even more excited. But it's interesting. We talk about the animal spirits. The US has had animal spirits being unleashed over the last few years. If it's translating this quickly into exuberance at a CFO level, not normally known for their exuberance, then maybe actually animal spirits arrive.
Moritz Kramer suggesting that maybe we need to keep our hopes of those animal spirits just a little bit tempered because of the time it'll take to deliver all of this.
He thinks the ECB forecasts are too bullish on growth. He sees 0.5% of growth this year.
Dare I mention the T-word tariffs, and we'll be back to talking about growth threats. Right, the Pulse is up next. This is Bloomberg.